The market is expecting interest rates to rise any minute now, but could it be that that moment could be years, maybe even half a decade away? I'm Jack Otter, editor of Barron's.com. I'm here with Michael Aniro, who writes our income investing blog. So, Michael, on Friday, the jobs report came out, 288,000 jobs added, a stronger number than expected. And, you know, we expect when we hear a number like that maybe that means QE will end, the quantitative easing will end sooner. Maybe the Fed is closer to raising interest rates. And at the beginning, the bond market sort of played along that script. Bond yields ticked up a little bit, and then that script was thrown out.
It's amazing how quickly this happened during the course of a single day. Bond yields started going up, seemed to indicate optimism about the growth of the economy in the spring. The jobs report, the number beat expectations. Unemployment rate fell to 6.3%. Everything looked good for about an hour. And then about an hour later, people had started to look a little bit deeper into the report, saw that the labor force participation rate continued to fall, saw that wages would remain flat, and said, hey, maybe this isn't such a great report after all. Maybe this isn't showing any kind of growth along the lines that we really would like to see at this point. And bond yields fell over the course of just Friday afternoon. The 30-year yield in particular hit a low that hadn't been seen in 11 months, and the 10-year yield was right near its 2014 low. This is pretty much the opposite of what people were expecting, especially given what looked at first like a reasonably strong number.
So the conventional wisdom is, okay, fine, but this only pushed the inevitable off a little bit. You know, any day now, interest rates are going to start to rise, and we'll see an inexorable climb. But Randy Forsyth in the Up and Down Wall Street column this week, he quoted someone who said, in fact, we don't expect rates to rise for years. What's up with that?
That's a contrarian viewpoint, but it's a quietly persistent viewpoint. You're hearing it, especially after we're now into May. Everybody expected coming into 2014 that bond yields were going to rise in accordance with economic growth, and we're not seeing that. In fact, we've seen just the opposite. Bond yields have fallen quite a bit. And every time it looks like they might take a step higher, they suddenly don't. And so you're starting to hear, again, it's a contrarian viewpoint, but people say, hey, maybe if you're looking ahead, maybe we're not going to see this kind of growth. And the report that Randy picked out in particular, was that there's going to be there's this greater capacity now in the economy than we're going to have use for, and companies both here and in emerging markets are going to get weighed down by debt service costs, and that's going to handicap the Fed in terms of its ability to raise rates, not just for another year or year and a half like markets expect now, but through the end of the decade. Again, a contrarian viewpoint, but there's a certain logic to it.
And there's also one important nugget of truth there that I think largely because of political discussions is ignored, or at least not enough weight given to the fact that we still suffer from a lack of demand. And to me, the argument ought to be over how to produce that demand. If you think the government's the wrong person to do it, fine, but don't pretend like we have enough demand, because we clearly don't. Given all this, and let's just say we don't know what's going to happen, which is hard to say, but if we don't know what's going to happen in the market, how should an investor handle the bond portion of his or her portfolio?
Well, if you're inclined to take somewhat of a bearish perspective, it doesn't have to be that rates are going to stay low through the end of the decade, but that they might stay a little bit lower longer than you expect, then kind of straight down the middle bond funds are looking pretty good. I mean, treasury-centric type of core bond funds, unconstrained funds tend to expect a little bit more of a rise in interest rates. The trouble that you might find in bond funds if rates were to stay low for longer, you could run into trouble for, say, junk bond funds or things like that. They have higher rates, but they're dependent on an economic pickup. And if that doesn't happen, then these companies with junk ratings are going to have a harder time producing the business to keep that momentum going.
So we're, without saying it, but we are quietly suggesting maybe people ought to own treasury bonds. I can't believe we're saying that.
It's about as unattractive looking as possible when you look at their yields, and yet when you look at the economy, there's definitely reason there.
Thanks very much, Mike.